Hey guys, Olga is here. This is Money Value and we are back to tell you about something you definitely need to know. This is something that most investors are focused on, and I'm talking about my new golden monkey. Of course no, I'm talking about dividends. You must be wondering, how do I get dividends? What should I pay attention to when choosing papers? When should I buy them? Well, do you remember I promised to walk you step by step? I'm keeping my word. Let's start with the basics. Dividend. What is it? When we buy stocks, we basically buy a share, which means we now own a part of the company. And just as any owner, we have the right to receive a part of this company's income. A dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or a surplus, it's able to pay a proportion of the profit as a dividend to shareholders. But what happens if there is no income? I mean, what if company gets a bashing? In most cases, shareholders don't get anything. However, sometimes top manager can make a decision to please the shareholders and pays them with undistributed profits of previous years or even take a loan. I can't tell how frequently you are going to receive your dividends or how big your income will be, but what I can tell you is where to find this information. You can find all the answers in a company's dividend policy. Anyone can read through this document. Just open the website of the company you are interested in and click the button Investors and Shareholders. Here are 3 steps for you. First of all, soak a history of the company. Before building your own dividend portfolio, you might find it useful to check the dividend payout. For example, some companies have never distributed profits, so it would be kind of naive to hope that the emittent is going to start with you, especially if this action wasn't announced. I'm not saying it's absolutely impossible, it's just usually the company proclaims the dividend policy changes so that investors would be more interested. It would definitely drive up demand, and that's what the company needs. That being said, you better choose those companies which distribute dividends like clockwork. Your first choice is somebody who manages to generate profit despite of market downfall and competitive businesses. Secondly, have a look at the dividend policy. Trust me, you can find lots of interesting things there. As I've already mentioned, you can find it online on the company's website. In case you've forgotten, this statement covers such things as part of the income spent on dividend payout, its frequency, etc. Basically, that's the first thing you want to know. Last but not least, evaluate the budget bottom line. Well, nobody is perfect, and even the best established company that have a great history of making awesome profit and paying their shareholders generously sometimes fall out of the pool of trustable ones. In the US, there is such a concept as dividend aristocrats. That's what they call those companies which have stable payouts and regularly increase them. It's not that easy to get a place on the list of dividend aristocrats. In order to achieve this goal, it's necessary to be a part of broad market index S&P 500, increase their dividends every year for at least 25 years in a row, and have at least 3 billion enterprise value. Here are 5 criteria you need to consider before purchasing dividend stocks. The first one is market trend. The market is really loop structured. Don't forget about it when you consider buying a stock. Is it a really good time to purchase? As Warren Buffett said, even a good stock can turn into a bad one if the timing is bad. Well, it's not the direct quote, but you got the idea. In order to avoid it, you gotta see what the market trend is by opening daily, weekly, and monthly diagrams showing the changes. If the first 2 show increase, you might consider buying the stock. If what you see is the opposite of increase, there are 2 risks. First of all, it can fall even more, and in that case, it won't be compensated by the dividends. Secondly, when the stock decreases dramatically, there's a good chance the owner will pause, cut, or even cancel the dividends. What's in it for you? Well, you might lose your money or simply have the dividends decrease. As for those graphs, you can find them in the internet. For example, you could visit finviz.com, investing.com, tradingview.com, and many others. The second one to consider is dividend payout history. Before you become a shareholder, you're gonna make sure that the company has no troubles paying the dividends. Best case scenario, if it also increases the payments. You can check how much and how frequently those payments happen by simply browsing the internet. You'll easily find the report you need so much there. As you can see on the example, American Express payments happen once a quarter. Besides, you can see what the to-be ex-dividend date is. It's important. If you want to get your dividends, you gotta purchase the stocks before that day. We're getting to the third one here. Dividend payout ratio, or DPR. After you've checked the dividend payout history, you might be willing to check this one. It will let you know which part of the income the company is going to spend on dividends. It should be just about 40 to 70%. If the DPR is more than 100%, don't get excited. It doesn't mean you're gonna get more than what company has. Well, actually it does, but that's not the point, and it's definitely not good for you. And this is why. If the company spends everything it gets on dividends or even takes a loan, it means that it has nothing left for business development. It means that sooner or later, all the debts will make the company cut or even cancel the dividend payouts. You don't want that, do you? When you want to check the DPR, going to the web is really helpful. Search the name of the company you are interested in and look for a table with the detailed data, including the DPR. For example, you can see how the Altria Group DPR is 92.3%. Not that great, is it? We got two more left. Business profitability. The dividends are paid with the net profit. Net income is the entity's income minus cost of goods sold, expenses, depreciation, and amortization. You got the point. That's why you need to check how profitable the business is. To do that, you need to be aware of what gross margin, profit margin, and operating margin are. Where can you find it? Yep, on the web. You can use the websites I have mentioned a little earlier. They make it a bit easier to search by coloring good markers green and bad ones red. You can rely on that while choosing the stocks. Basically, all you gotta do is make sure that gross margin, operating margin, and profit margin are all green. Check this one out. Those are the BlackRock's numbers. That's what healthy, profitable business looks like. Finally, the last one, debt load. Besides profitability, you gotta be aware of the company's debt load. The more debts company has, the more difficult it's gonna be to pay the dividends. Check this example out. You can evaluate the debt load by the debt to equity ratio. By the way, those numbers are BlackRock's. Well, the balance sheet resilience is just below the line of 0.75. It won't come as a surprise to you that having too much debt is not good for financial strength, which means the dividends are jeopardized. However, in the USA, companies rarely cancel dividends. It shatters investors' confidence in the papers. Nevertheless, don't risk it. Just stick to the emittents whose debt to equity ratio is normal, just between 0.7 to 0.8. I think that's pretty much it for today. I'll give you some time to digest all the information. Meanwhile, here's a sum up for you. When you are choosing dividend stocks, pay attention to the market trend, company's payout history, dividends, it should be less than 70%, profitability, gross margin, operating margin, and profit margin should be all green, debt load. It should be less than 75 to 80%. I hope this video was helpful. Don't forget to apply all of this in practice and take care. Smash that like button, subscribe, and I will really appreciate if you share this video with your friends. Thank you. See you soon.